Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. Once again, it's my great pleasure to invite you to another Subscriber Request Tuesday video series that I've been doing for some time now. I've kind of got a special one, I think, this time for you, one that I am kind of excited about and hope you will too. You know, one of the things that happens, I might, go ahead and lament about this a little bit, if you will, is I get a lot of requests to cover stocks. And frankly, I wish I could cover them all, but I can't. There's just way too many, especially stocks. If I'm not familiar with the company, I tend to be reticent to cover them. But, I do try to cover them when I can and try to give you as much, feedback as I can when you ask me to cover these companies. So I'm going to try to accomplish two things with this particular series. Number one is one of my good clients and friend, and Mike, if you're watching, his name is Mike. He and I were having a discussion, actually going over his portfolio and discussing investment philosophies and strategies, the state of the stock market, which we both agree is significantly overvalued, etc. And he gave me he asked me an inspirational question. He says, well, what about hedging? Do you have any hedges, or do you believe in doing any hedges with the portfolio? And so one of the goals I'm going to try to accomplish with this video is I'm going to talk to you about what I consider to be the very best way to hedge a portfolio from a pending market crash. So thanks for that, Mike. But the second thing I'm going to do, I'm going to only use companies that you have asked me to cover in your subscriber requests over the time. So that way I'm going to kill two birds with one stone and try to get this message, a very important message across of what I believe is the best way to hedge. Now, I do want to make a couple of comments. Go ahead and do it early in this video. I don't believe in options. I simply don't have the time. I don't want to be sitting there trying to watch every little wiggle in the stock price. Stop losses, are another hedging technique that some people use. They don't always work. Sometimes they do, to be fair. But if you get a flash crash like we had with the COVID crisis back in, March of 2019, they don't, or 2020, they don't work. Okay, the stock price can go right through your stop price, and you can end up selling the stock at a significantly lower price than you would have been willing to accept, if there was something like that, a panic sell-off came. So, I'm not big on that. I don't really particularly like gold and things like that. And of course, then we have the great hedge fund industry, which has proliferated, which was originally a concept that said a hedge fund would hedge you against the market. It would theoretically move in the opposite direction of markets. Hedge funds don't quite work that way anymore. They're really nothing but limited partnerships with different investment strategies. Some of them use alternative products, real estate, private equity and things like that. So there's a lot of different ways to hedge. But I want to talk about hedging in a much more practical way, and I'm going to use some examples here to cover that. So let's go ahead and get into it and talk about hedging. Okay, the first thing I want to talk about is the whole idea of being fearful of a quote-unquote market crash, because that's really the bottom line. People are afraid of losing all their money. Ultimately, the big risk that people feel, I think, investing in stocks is they're going to lose 100% of their money. That virtually never happens, or rarely happens, although it has happened on a few occasions. But I'm going to talk about antidotes to protect yourself from that here as I go through this video. But the reality of it is, if you look at market recessions or market crashes, there's a couple of statistics that I think you ought to have in the back of your mind. Number one is, I found a site called Stock Market Basics, and they put out some data, and I haven't checked this data, but it seems to make sense to me. They said the average gain in a bull market is about 160%. Okay, the average loss in a bear market is down 25%, 27%, I think they said. The average length of a bear market is 52 months, which is obviously slightly over 4 years. And the average length of a bear market is about 14 months, or just slightly over a year, if you will. Now, on the FastGraph research tool, we mark recessions. And I'm going to start by taking a look at the S&P 500. On the new version, we also have the COVID flash crash here that you see right here. And I want to use this as, as some evidence of that. Now, this particular website went back to 1956. I'm only going back to the year 2000, okay? But we've had three recessions, if you will. We had the 2001 recession, which was very short-lived. You can see it lasted less than a year here. Then we had the Great Recession, which was the second worst recession, I want to emphasize this, that we've had since the Great Depression of the 30s, or 1929 to be specific. Okay, so this was like the big kahuna. This is one of the worst we've ever had. Now, I want you to notice a couple of things. This is using the S&P 500. Number one is that the big risk was when you have overvaluation, like I believe we have right now. So that's when a market crash could damage you the most, because you get the market moving back into alignment with intrinsic value, okay, which is the orange line on this graph. The blue line is the normal market value. Now, you also have the issue of falling earnings. I want to emphasize that as well. That's another issue that I'll talk about how we can, fight that issue as well. And then you also have the issue of cutting dividends, which the S&P did cut their dividend in 2008 coming into 2009, but very temporarily. And then they started raising their dividend again, and the dividend went higher than it had ever been before very quickly. And then, of course, we had the COVID recession, which I'll show you here in a moment. But the point is, I want you to understand just simply this from what I've covered so far. Recessions tend to be short, bull markets tend to be long-lasting, and of course we're in one of the most long-lasting bull markets ever, and that's notwithstanding the fact that we had this quote-unquote flash crash in 2020 when the COVID pandemic hit. So I'm going to start out by looking at individual stocks. I do want to come back to that S&P graph a little bit later in this presentation, but again, these are stocks that you all asked me about, and I'm going to use them to cover what I consider to be probably the top 6 or 7 ways to hedge a portfolio. All right. Number one, and the absolute most important one, is to always attempt to invest with a margin of safety. Okay. You want to buy value. Okay. Overvaluation is actually a significantly bigger risk than a quote unquote short-lived market crash in my experience and in history. But that's also assuming you're buying good, consistent growers. I've got Pepsi up here. Now, Pepsi is a very interesting example for a couple of reasons. One is, I want you to notice that the market typically values this at around 21 times earnings. That's the blue line. That's a premium valuation. A lot of the big brand names like Pepsi, Coca-Cola, names like that, even McDonald's and so on, they tend to sell at premium valuations chronically, meaning they're always at a premium valuation. What's interesting is when, the recession of 2001 came, the company actually did quite well. When the recession of 2008 to 2009 came, once again, the company did quite well. Their earnings growth slowed down to 1%. You can see it here. If I take the price off the graph, you can see that the earnings flattened a little bit, but they didn't fall. The company was still extremely profitable, still had the highest profit in its history, by the way, coming into for the 2009 year, as well as the 2008 year, and well as the 2007 year. Okay, now the price reaction was also very interesting. Pepsi entered the Great Recession overvalued. Okay, now if I go ahead and just calculate this as closely as I can, and this is rough, so don't, it's not perfect, but the point is we had about a 35% drop in Pepsi during the Great Recession, even though the earnings didn't drop and even though the dividends continued to grow. And that dividend story is going to be important. I'll get back to it later. But the point is, the big culprit here was a very high valuation. Now, as a result of that, with no margin of safety in the stock there, it did take, if you look at this price as $77 a share, and that was in December of 2007, it took, out to about 2013 or so, March of 2013, before Pepsi stock broke even again from a standpoint of, what was the damage. But the reality of it is I wouldn't have invested in Pepsi at these levels because I would have not considered it to have a margin of safety. Now, you never get a true margin of safety in Pepsi, at least not in these last 2 decades, but you did have an opportunity for about 3 or 4 years where you could have bought Pepsi at a very attractive valuation coming out of the Great Recession. So let's go ahead and shorten the graph here a little bit, and let's look at what the performance of Pepsi would have been coming out of the Great Recession when the stock got fairly valued. Okay, it was overvalued here, and it's overvalued now. From this point of view, performance was 5.53% capital gain, plus dividend income that actually grew on average of about 8% during this time frame, which is December of 2007 to 2021. We end up with a 7% rate of return, but we actually underperform the stock market. Okay, now let's shorten that a little bit. All right. Let's take that into where we actually have fair value. So I'm going to shorten it to where the stock now becomes reasonably valued based on this graph. And now I've got the stock trading at around 16 times earnings. Let me do one more here. Let me go back one more. Now I've got the stock trading at 14.5 times earnings. That's over a 6.5% earnings yield. that gives me an opportunity, and I had that opportunity for 3 years here to invest in Pepsi, and that would have ballooned my rate of return. My capital appreciation would have went to 8.7%, my total return 10%, and I also want you to point out that you ended up making significantly more money. This is based on a $100,000 investment, just as a metaphorical calculation, if you will. You still underperformed the market, but you ended up with a nice solid double-digit rate of return, owning a stock that, you bought at an attractive valuation. So investing with a margin of safety is one of the best ways that you can actually fight inflation. So let's go ahead and look at some other examples here. Let's look at Oracle, the tech stock. And I'm going to go ahead and expand the graph out again, because what I want you to see with Oracle is that the constant reverting back to the intrinsic value. In other words, the stock price gets disconnected from the orange line. Okay, but it always comes back to that orange line. It entered the 2008 recession pretty, fully valued, maybe not even dramatically overvalued. And as a result, we ended up with about a 25% drop in fair value, or in the value of the portfolio. And by the way, if you'd have bought it here and held it to here, this would have been an unrealized loss. Okay, I want to also make that point about trying to hedge. You didn't have to take that loss unless you decided to or panicked, okay? So if I recalculate that, at a stock price that was $20.68, you can see that I'm back to $20 and basically, 68 cents within a year's time frame here if I'd have just held on to the stock and not lost money. And then if I'd have held it on all the way to current, which, by the way, I consider Oracle overvalued now I have a rate of return of over 17.7%. Pardon me, with the new version, you can see there's still some bugs here. I can, look at performance for you, though, just to give you an idea. This would have been a good time to buy it, but the best time to buy it was when the stock was trading at these discounted valuations here, where it was trading below that margin of safety. There was no time on this graph, and I want you to just really focus on that, where you bought Oracle with a margin of safety, which simply I'm defining as when the price is below the orange line, which is a 15 PE. If you bought Oracle at less than a 15 PE at any time, you would have gone through every recession that we've had. Now, you wouldn't have been able to do it in '01, but you'd have gone through the big recession and the flash crash of the COVID recession without losing any money at all. If you'd have just been patient, even if you'd have bought it back here, okay, where it was below the line. I do want you to make it clear. You could have bought it at 13 times earnings on December of 2018. And if you held it to the bottom of the flash crash, you were up about $3 a share, from $44.82 to $47. And of course, today, the stock trades at 90. So the point is, the best way to hedge against a recession, one of the best ways to hedge your portfolio, is always invest with a margin of safety. And in line with that, buy the business, not the stock. Let's get the price off, which is what everybody focuses on, the stock price. And let's just look at the business. Here you've got a very consistent business that has grown earnings at over 11% a year. And if I compare that to the market, that's almost twice as fast as the S&P 500. I want to make that point. So you've got a really solid business here. And the key is you want to buy the business when its earnings are growing, not when, you don't want to invest in a business that has collapsing earnings. Let me see if I can find one here for you real quick. This would be a good example of what I'm talking about. Okay, this is a company who's just never made any money. This was a subscriber request. Statistically, it looks good. Okay, statistically, we've got an earnings yield of 23%, blended PE of 3. All that sounds really good, and it might be if you were willing to speculate in this company. It does look, have some forecast earnings growth, but this is a company that's obviously been very, very erratic on its history. Even paid a dividend for a little while and then canceled it. And, you buy it here and hold it to here, which is probably 15 or 20 years here, and you end up losing, 89% of your money. You want to hedge your portfolio by not investing in this kind of company, especially as being a long-term investor, which leads me to the next, I think, really, really strong hedge, and that is to be a long-term investor. Okay, buy the business when it's attractive. And, sometimes you have to wait patiently for long periods of time. Here's 3M. I believe for a 7.76% grower, a 15 PE is fair value. The market likes to put a premium value on this stock because it's one of those big brands, like I talked about with Pepsi. Okay, but even if you bought it on that basis, you could have had trouble for a long period of time. The safest way to buy a stock and to hedge your portfolio is to be very, very disciplined with valuation. Only be willing to buy when valuation is low, and you will inevitably get your opportunity. Sometimes you have to wait a long time. Here you waited 5, 6, 7 years before. You got pretty close right here. You could have bought it in August of '06, coming out of the 2001 recession, if you will. It got pretty close to reasonable value right in here. It got really inexpensive. And again, I want you to note the impact of overvaluation plus fair valuation. If you'd have bought 3M when it was fairly valued here at a PE of about 14, with an earnings yield of pretty close to 6, 7%, you would have had a loss of about 38%, but you would have also recovered from that loss in really a year's time. Okay, so this was unrealized loss. If you didn't take the loss and just held on, invest for the long term, you'd have been even again real quick. And note that you kept getting increasing dividends. So if you were focused on the dividend, which is another way to hedge, focus on the dividend, invest in dividend paying stocks because you can continue to get an increase in pay. And let me illustrate that. Here we have 2008. Dividend was $2 and it went to $2.04, then to $2.10, then to $2.20. And you can see your income on a $100,000 investment went from $3,320, $3,390, $3,490, $3,650, etc. The point being is that you continue to get an increase in income. If you're retired, for example, and living off your dividends, this loss didn't hurt you at all because the key point here is your dividend is calculated based on the number of shares you own, not the price of the stock. So even though the price fell, your income kept going up because for each share that you owned got more dividend income next year than it did last year, and so on and so forth. So that's the advantage. Now, you could have bought then 3M, at fair value for several years. You had a margin of safety opportunity again in September, but then you went through 4 or 5 years where you couldn't have bought it. But then again, the COVID crash gave us an opportunity to buy it at a relatively reasonable, not a great margin of safety, but at least at fair value, coming into March of 2020, you could have bought 3M, once again. So invest for the long term. Pay very close attention or try to focus on dividend income to the maximum extent that you can, because ultimately that's where you make your money. And, I can show you several examples of this. Another company that I was asked to cover was OMC Corporation, which is an advertising company. Okay, and advertising is obviously an industry in flux. I want you to notice again, overvaluation is much more dangerous than these recessions. Overvaluations tend to last or damage your money or your portfolio for a lot longer period of times. Crashes tend to come and then recover, especially if you're buying with the margin of safety. If you're buying OMC here when it had a margin of safety, even though you could have seen a slight drop in price over the next several months from $30 to $22, you were back to over $30 a share in just a couple of months, even less than a year's time. And then, of course, the stock has done this now. The same with the flash crash. We had this flash crash. The stock languished here for a few months, but now we're back up to having it be worth more than it was before the crash occurred because there was a margin of safety here. I want to make it clear that I'm not saying if you invest with a margin of safety that the price can't drop if there is a major crash or correction. It can. But the point is that the stock is going to consistently move towards its intrinsic value. I've always said, what I say about this is that, the academics try to tell us that the market is always efficient. Everything that can be known is always priced into the market, and the investor can never have an edge. Well, Warren Buffett once quipped that, if the market were always efficient, I'd be a bum on the street with a tin cup. The point is you exploit other people's folly. You want to exploit the inefficiency of the market by being very careful to invest with a margin of safety, but also invest in good, stable companies that have good long-term dividend records and increase their dividend, historically year after year after year. So that's a real key. Now, there's some other issues here I want to bring out. If you're not a dividend investor, you're investing in a more growth-oriented type stock. This is, the Boston Beer Company, Sam Adams, if you will. And this is more of a growth stock. It has a 21.8% growth rate, since 2006 here, since February of 2007, actually. And you can see that the company's earnings tracked that. And when it got overvalued, that was a poor time to buy the stock. And then it got really overvalued here. Overvaluation is another way to, I think, protect your portfolio. I never, ever have been ashamed of taking a profit. Even if I took a profit here and watched this, and I did that with Apple, and I'm going to admit it to you, but I don't care because I reinvested the Apple money and made really good money, but I did it at significantly less risk because here you would have had this, 83% short-term rate of return, but yet, because the stock was so overvalued here, now here we are just a few months later, and you've got a 22% negative rate of return, and I would still consider the stock overvalued. You want to invest for the long term. You want to buy the business, not the stock. But if you're going to buy the business, try to buy the business when you're buying it in line with its intrinsic value. And if you're retired especially, focus on the dividends. The dividends are, a real salvation for you, as I pointed out. Now, here's a financial. And what's interesting about MetLife here is that the company was trading, at following its earnings, had great earnings growth coming into the financial debacle. The stock was not overvalued per se. It was even possibly attractively valued, but again, trading at a discount of about 10 times earnings, 10.44 is the blue line. The earnings collapsed here. This is why due diligence then, constant and continuous due diligence and monitoring of your stock with a focus primarily not on the price, which I always stress, but on the earnings of the company. That's the key. Here we had 2 years of collapsing earnings, which basically are what really caused this significant drop, over a 70% drop in the value of your stock. So you can get, those massive close to 100% losses if you invest in a company that's having collapsing earnings, like I showed you earlier also with Genworth. But if you buy companies that are reasonably stable at good margins of safety, you're generally going to do well in the long run, but you've got to really pay attention to the earnings of the company. And MetLife is a moderately cyclical life insurer, as you can see. It's not uncommon for them to have periods of time where the earnings get, weaker than they were, previously. All right. Another example kind of that's a little bit off the norm here, because, there is no such thing as a perfect hedge, including the ones that I've been sharing with you here. But having said that, overvaluation, I'm known as Mr. Valuation, is always more dangerous than a market crash, okay, or a market correction. Because here we got Walgreens Boots Alliance, significantly overvalued coming into the 2000 correction. This led to at least a lost decade of, not making any money in this stock. I could have extended it out here even further, simply because the price of the stock was overvalued relative to the true value of the business. But when you got a chance to buy it at a good value, like here in June of 2012 at a 10 PE, you then would have still suffered a big loss here. We had overvaluation. I want to emphasize the stock got way overvalued here, and everybody loved it. When I told people it was overvalued, they told me I was nuts. This led to, this was a great, 40-some% annualized rate of return during this period of time. But then when it finally peaked, and by the way, I had no idea, nor does anyone else know when that peak would have occurred. They don't ring a bell at the top or bottom of markets. Today you would be down over 46%, annualized loss of minus 7% per annum owning this stock. But again, we did have, earnings fall here during COVID. But also, I want to point out, you've got the opioid crisis, which put a lot of healthcare stocks in deep doo-doo. But if you'd have bought this stock at a reasonable margin of safety, I didn't hit the bottom here on purpose, and held it today, even at these discounted valuations, you still end up making 6% a year annualized, including dividend income. In other words, it's not Armageddon. You didn't lose all of your money by investing, in the stock. Now there are growthy stocks like CarMax here, which the same principles apply. The difference is when you got stocks growing at 15, 20% a year or better, the most important thing you want to watch is the operating results. Now, CarMax went through the 2000 recession with pretty good growth. The 2008 recession led to 2 really bad years of earnings. Even though they stayed profitable, their earnings did drop 67% through fiscal year February of 2009. And of course, the stock price tracked that. And you rarely got an opportunity to buy this stock with a margin of safety. You had little margins of safety in, February. Here you got a 15 PE, but for a 17 or 18% grower. The orange line on this graph is a PE of 17.3, just to be clear. And then the flash crash came, and this is what's interesting. This is one of the things that I really like this example, regards to the fact that it pays dividends, because had I purchased CarMax here when it had a nice margin of safety, a PE of 12.58, with a company growing at double-digit rates, and the stock fell all the way down here to where the PE got down to 8 during the COVID crash, I would have lost money over that 2-year period. But look how quickly the stock recovered back to the $58 a share, and then how it's gone on up after that. So buying with a margin of safety is a great way to protect your money if you're willing to be a long-term investor in the stock. I think that's another key point. But you also got to do your due diligence, and you only want to do that when you expect the business to continue to grow. If you don't think the business is going to grow, if you feel like you've got a business that has, really poor earnings, like here's one that's people ask me about, I would, never, I'm not sure if this graph is actually accurate, so I'm going to skip this one. All right, let me talk about Brunswick here. This is the case where I'm talking about, where its fundamentals are more important than a bear market, and they're also more important than a temporary drop in the market, et cetera. Because here what you had was a period with Brunswick where you coming into 2005, you had several years of falling earnings, and then you had several years of losses of earnings. So no matter, even if you bought the stock with a margin of safety here, you would have still lost money. You'd have had to hold it for years, 4 or 5 years here, and still had significant losses because the business was doing poorly. You buy good businesses with a margin of safety, businesses that are continuing to grow. Now, Brunswick kind of got their mojo back. And, since they've kind of gone through here, now all of a sudden the stock has done pretty well. But this is not the kind of company that I would be very excited about investing in, even though their earnings and growth looks pretty good coming up here. But once again, we still see those principles at work. The company did well. When the company did well, the stock did well. And when you could buy it at a margin of safety, you usually had a great hedge there. You were really protecting your money, significantly during that time. So let me go ahead and wrap this video up here. Well, let me look at 2 more stocks. Let me look at Viacom here. This is another example that I wanted to make it clear of. Here's a company that's very, very cyclical. Look how overvalued it was coming into the recession of 2001. The business did well up through 2007, but because overvaluation was so high, this is where margin of safety, this is the opposite of margin of safety. This is with no margin of safety. You still, even here when it recovered a little bit, you still ended up losing a significant amount of money owning the stock. You would have bought it at $40 a share and the price was $35 a share 5 years later. Then the recession came and the earnings collapsed. So you've got to do constant monitoring and due diligence as well. They slashed their dividend. Not all dividend paying stocks have perfect dividend records. So another great way to hedge your portfolio is pay attention, which brings me to diversification. My argument is diversify enough to protect your money, but not so much that you can't keep track of the companies you own. Because here you can see that it's just, craziness on this stock. Here's where we had, this is obviously the broadcasting company. Here we had this huge, collapse in value and coming into COVID. And then we had this massive spike in value. And then the price came down. But you have a very inconsistent, very erratic company here. And, all hedges, even the ones I'm talking about here, don't always work. But if you're prudent, if you do your homework, if you maintain, a continuous or constant monitoring and due diligence, that means, always be looking at, in a case of a common stock, to me, that primarily means looking at each quarterly report and paying attention to what the business is doing as they report their financials each quarter. You don't have to be doing that. That doesn't mean every second of every day. Invest for the long term. Always try to invest with a good margin of safety. I think that's really, really critical in this whole discussion. And, buy the best companies you can, but try to buy them when you can get them at attractive prices. But even a company like which I'll end with, Stanley Black & Decker, the company had some issues during the Great Recession, but it stayed profitable. But this was real. This was a justified drop in value. But again, if you invested for the long term and still believed this business had a future, as long as you bought the stock when the price was below the orange line, you would have done okay in the long run. You don't want to buy the stock when the price is disconnected. Here you had a pretty quick correction. Then it got overvalued again. Then COVID came and we saw this huge drop, and now it's overvalued again. So the point is, I believe the best way to hedge is follow the principles of value investing, invest in the highest quality companies you can, pay attention to dividends, buy the business, not the stock price. Don't focus on price, focus on fundamentals. Do your homework. Diversify enough, which is to me 20 to 30 stocks, but not too much that you can't follow them and know your stocks, because knowledge is power. Anyway, I hope you enjoyed this video. It's been Chuck Carmel saying thanks for watching. This was my regular Tuesday subscriber request series. Most of every stock I covered here was a subscriber request at one time or another. So I hope those of you who requested these stocks got the chance to see this video. If you liked it, give me a like and a thumbs up. Ring the bell, subscribe to the channel so you can see more videos like this. You might also want to try a free trial of Fast Graphs. It's a great tool, and this is the new version, which is still a little buggy, but I hope just by showing you the video and using it in this video, you can see we're getting real close to launch. We're hoping in the next 2 to 4 weeks, we'll be able to have a launch out there for all of you that are subscribers. You're going to like what you see. Thanks for watching.